Options trading has to be one of the craziest ways that you can either lose a ton of money or make some income through the stock market. I've gone from losing $12,000 on a single trade in just 1 week to now making $1,000 a month in income from trading options. So today I'm going to be teaching you the basics of how to trade options, and at the end of this video I'm going to give you some real examples. Now, before you start trading options, you'll have to set up a brokerage account. And in the US, we have plenty to pick from. If you want a pretty user interface, then Robinhood is probably your best bet, but you can also go with Webull or a new one called Moomoo. But if you don't care about the user interface and having it easy to use, then you can always go with the old school Fidelity or TD Ameritrade. Now, if you're outside of the United States, then unfortunately, there's not a ton of options. The most common one that I've seen for international traders has been Interactive Brokers, but I've heard a lot of comments on their user interface saying that it's not the best. So you can go and Google the best brokerage for trading options in your country, but you'll probably be stuck with Interactive Brokers. And once you've set up your brokerage, then you're going to have to actually apply for options trading on that account. And this is going to have you fill out a questionnaire that's going to ask for your yearly income, your net worth, and your trading experience. And whatever you put into this questionnaire is going to determine your options trading level. Now, you have level 1 and level 2 options trading, which you should get approved for as a beginner, and this will allow you to buy and sell regular calls and regular puts. Then there's level 3 options trading, which allows you to trade spreads. And finally, level 4 options trading, which you can sell naked calls and naked puts. Now, these are strategies that you're going to learn about later on in your trading career and after you've built some experience. That way, whenever you fill out this questionnaire again, you should be approved for level 3 and level 4 options trading. And after you fill out this questionnaire and hopefully get approved for options trading, you might want to set up a margin account. Now, you have a margin account and you have a cash account, and there's pros and cons to each of these. With a margin account, you don't have to wait for your cash to settle, because whenever you trade options, it'll take T, the trade, plus 1 day in order for your cash to be available for your next trade. So if you've used up all of your buying power, then you might have to wait an extra day after you've closed out of your trade in order for that money to be available again. And that's with a cash account. But if you have a margin account, this doesn't apply. This is available to you right away and as you make a deposit. Whenever you make a deposit, it's going to be available right away, but with a cash account, you're going to have to wait again, usually around 1 to 2 days. But the pros whenever it comes to having a cash account is that you have an unlimited number of day trades, whereas with a margin account, you have to have over $25,000 in your account in order to have unlimited day trades. So if you have less than $25,000 and you want to be a day trader, then you might want to set up a cash account. And finally, once you've figured all this out and set up your account, then it's time to start trading options. Now, whenever you start trading options, you're going to be limited in the type of strategies that you can use. But you do have 2 main ones starting out. You have buying an option, just like you would buying a regular stock, but you can also sell an option in order to open it. Whenever you sell an option, you're creating an entirely new one, or what's known as writing an option, and somebody else is buying that option from you. Now, whether you're on the buying end of an option or the selling end of an option in order to open it, you're going to get a price for that option. And the price for an option is also known as premium. So if you're buying an option, you're going to be paying a premium in order to open it. But if you're selling an option, you're going to be receiving a premium or a credit in order to open it. And the goal whenever you buy an option is for that premium to go up. That way you can sell that option back to the market at a higher price and take a profit. But whenever you sell an option to open it, you're hoping that the price comes down. That way you can buy it for cheaper or just let the option expire completely worthless. And this is one of the biggest differences between buying stock or shares of a company and buying an option. Because the odds of a stock going to zero are pretty low, but the odds of an option going to zero are relatively high. You see, this happens because the right to either buy or sell 100 shares of your stock becomes worthless at a certain point, and this depends on your strike price. Now, whenever you buy a call option, you're agreeing to buy 100 shares of your stock at your strike price. And if the stock is below that strike price on your expiration date, you wouldn't want to buy the stock at the higher strike price. you would want to buy it at the lower market value. So this call option is going to be out of the money, and whenever it expires, it's going to be completely worthless. And whenever you buy a put option, you're agreeing to sell 100 shares of your stock at your strike price. So ultimately, you want the stock to be below your strike price on your expiration date. That way you get to sell the stock for more than it's worth. But if the stock is above your strike price, then that put option has zero value to it. You wouldn't want to sell the stock at a lower price than what the market value is for that company. So this put option would be out of the money too. But you can also sell options in order to open them. And your goal is for that option to expire out of the money if you want to collect the full credit or the premium that the buyer paid you. Whenever this option expires completely worthless, all that credit gets collected and it goes back to you as a person who sold that option to open it. But the person who bought that option unfortunately loses everything. But whenever you sell an option, you can also be forced into buying or selling 100 shares of your stock. So whenever you sell a call option, you're agreeing to sell 100 shares of your stock at your strike price. And if it's above that strike price on your expiration date, then you're going to be selling it for less than what the market value is for that stock. So say you sell a $100 call, but then the stock ends up going to $110 on your expiration date. This means that you could have sold the stock later on for $110, but instead you agreed to sell it at $100. This means that you missed out on $1,000 more profit that you could have had otherwise if you hadn't sold this call option. And whenever you sell a put option, you're agreeing to buy 100 shares of your stock at your strike price. And if the stock is below that strike price on your expiration date, then you're going to have to buy 100 shares of your stock at the strike price no matter what the price of the stock is at expiration date. So say you sell a $100 put option, but then the stock ends up tanking to something like $50 for whatever reason. Then you could have bought the shares for $50 cheaper than your strike price. So here you're taking a $5,000 loss on that option. And this is just intrinsic value, or the difference between your strike price and the stock if the option is in the money. Now I know that in the money and out of the money can get a bit confusing, especially when you're working with calls and put options. But you have to think of it this way. Again, whenever you buy a call, you're agreeing to buy 100 shares of your stock at your strike price. So you want the stock to be above your strike price, that way you're getting a discount. So a call option with a strike price below the current market price for the stock is going to be in the money. And it's the opposite for put options because you want to sell them at a higher price than the market value. So if the strike price is above the market value for the stock, then that put option is going to be in the money. And then you also have out of the money options. So an out of the money option has zero intrinsic value because, again, it doesn't make any sense to want to exercise your right to either buy or sell 100 shares of your stock. For example, if I buy a $100 put option agreeing to sell 100 shares of my stock at $100, but it's trading at $110, why would I sell the stock for $100 when I can sell it for the $110 market value? Doesn't make a lot of sense. So this put option is out of the money. And again, whenever you buy a call option, you're agreeing to buy 100 shares of your stock. So if I buy a $100 call and the stock is trading at $90, why would I want to buy 100 shares at $100, my strike price, when I could buy them at the market value at $90? That call option is out of the money. So that's in the money and out of the money and intrinsic value. But there's also another value that makes up the premium or the total price of an option, and that's called extrinsic value. It's also referred to as time value because this is dependent on time, one, but also the volatility of the underlying stock that you're trading. Because whenever a stock is more volatile, it's more likely that the option is going to gain value. So the higher volatility on the stock that you're trading options on, the more expensive those options tend to be. And the longer your expiration date, the more time that you're giving the stock to go in the direction that you chose, so the more that you're going to pay for that option as well. So again, the more volatility a stock has and the longer your expiration date for an option, the more expensive that option is going to be. So we talked about intrinsic value, we talked about extrinsic value, and pretty much everything that you need to know about trading options. So let's get into some actual examples for you. Now, whenever you buy a call option, you should hope that the stock goes up because as the stock continues to go higher and higher, this makes your right to buy 100 shares of the stock more and more valuable. So if I think that SPY, the overall market, is going to continue its rally that it's seen over the past couple of weeks, then I would go and buy a call option. So I'd go to the option chain on Robinhood, and then I would select my expiration date first. So this is the timeline that I'm expecting SPY to go up in simple terms. So if I think that SPY will go up over the next month, I would set my expiration date to the next monthly expiration date, or the next third Friday of the month. So for April, that's going to be on April 14th. So we're going to go to that expiration date, and then we're going to choose our strike price. And there's a lot of different ways that you can choose your strike price, but one of the main ways is making an assumption of where SPY will be by your expiration date. So if I think that SPY will be at above $450 by my expiration date of April 14th, then I would buy the $450 call right here, and I would pay $825 in premium in order to open this. So this is the cost of opening this option. And this adds to what SPY needs to be at in order for me to make a profit on my expiration date. So this is going to be what's known as your break-even price, which is the cost of your option plus the strike price whenever it comes to a call option. With a put option, it's the opposite. We'll talk about that later. But for now, let's talk about this call. So if SPY goes up really quickly, then this option is going to gain intrinsic value. So right now, SPY is at $451. But if SPY goes up by another $1 or $2, this option should gain around $150 of intrinsic value. But it's not quite that simple, because there's this Greek called delta. So delta is the amount that your option changes by for every dollar that the stock moves. And the delta for this option specifically is 53.4. So for every $1 that SPY goes up, this option is going to gain $53.40 in value. So if SPY goes from $451 now to $452 later, this option should be worth around $54 more. But you also have time working against you, and this is where theta kicks in. So the theta for this option is negative 19. And this means for every day that passes, even on weekends and on holidays, this option is going to lose $19 of value because of time and extrinsic value evaporating. Like we talked about earlier, the longer your expiration date, the more value that an option has. And the shorter your expiration date, the higher your theta value is going to be. So this one has a 19 theta value, but if we extended our expiration date to January 2023 and went with the same $450 strike price, the theta for this option is only 5.8. But this option also costs $3,543 in order to open it. So you can see how the expiration date affects the pricing for the option here. Now, if I think that SPY is going to come down over the next month, then I could buy a put option with the same expiration date that we had before on April 14th. So if I chose the same strike price, assuming that SPY would be below $450 on my expiration date, I would pay $701 in order to open this option. So that's the premium that I would pay in order to enter this. And I would hope in the meantime SPY comes down. That way the delta will increase the value for this option. The delta for this is going to be negative 46.5. The delta for call options was positive because we wanted the stock to go up. But with a put option, your delta is going to be negative because you want the stock to come down. So for every dollar that SPY goes down, this option is going to gain $46. So if SPY drops from $451 right now to $450, then this option is going to gain $46 of value and be worth around $745. And at the end of this, if I were to hold it all the way until my expiration date, I would want the stock to be below my break even, which for this is $450 minus our $700 cost to open this option. So I'm hoping at the end of this contract that SPY is below $443 in order to make any profit on this trade. But hopefully it goes down quicker, that way the delta can expand the value for this option. And again, you also have theta, so for every day that passes, this option is going to lose $19 of value. So if SPY trades flat for the next 3 days, this option is automatically going to lose about $60. So it's going to go from $700 right now to about $640. So that's buying options. Whenever we bought the call option, we thought SPY would go up. Whenever we buy this put option, we're assuming that SPY will go down. But you can also sell an option in order to open it. So instead of buying this put option, I could also sell this put option to open it, and I would be agreeing to buy 100 shares of SPY at $450. So this means that I'm going to need $45,000 of cash in order to open this trade to buy those 100 shares if SPY is below $450 on my expiration date. So I'm hoping that SPY will be above $450 so I don't have to buy the 100 shares. But if it is below $450, then I would have to buy those 100 shares, but I'm still keeping that $700 of credit. So since I'm selling this option in order to open it instead of buying like we were earlier, I'm going to get paid in order to open this trade. And whenever I get paid to open it, that credit is mine to keep until I buy that option back to close it, or I get to keep the entire $700 if I just let this expire. So if SPY is below $450, that $700 goes towards buying the 100 shares. So technically, we're buying these 100 shares for $443. That's our break-even price for selling this put option. Now, whenever you sell a call option, you're agreeing to sell 100 shares of your stock. So if we sold that $450 call, we're agreeing to sell 100 shares of SPY at $450. And we would need 100 shares of SPY in order to sell this as our collateral. When we sold the put option, we agreed to buy 100 shares of SPY at $450. We would need $45,000 of cash as collateral. But whenever you sell a call option, you need the shares as collateral. And this trade really wouldn't make any sense to open right now because SPY is at $452. So we'd be agreeing to sell 100 shares of our stock for $2 less than what the market value is right now. Now we will get more credit for opening this because this option is in the money, but ideally we want to sell the stock for a higher price than what the market value is. So if we sold this $455 call instead, we're going to get paid $565 of credit in order to open this, agreeing to sell our 100 shares of SPY at $455. So if SPY is above $455, this option is going to be in the money, which means that we have to sell our 100 shares at $455. But if we don't buy this option back to close it before our expiration date, we still get to keep that $560 of credit. So this means technically we'd be selling these shares at $460.60. That's our break-even price. And if SPY is below our $455 strike price, we don't have to sell our 100 shares. And if we don't buy this option back to close it before the expiration date, we get to keep that $560 of credit. So those are the 4 ways that you can trade options whenever you're first starting out. And you can also close these before the expiration. So say we bought the $450 call originally and the stock ends up going up, we could sell that before expiration. We don't have to hold this option into expiration. So if we buy it now, we're hoping that the stock goes up. That way we can sell this option back for a higher price. And then whenever we sell the 455 call like we did before, we're hoping that SPY comes down in the meantime. That way we can buy the option for cheaper. Or we just want the option to expire out of the money where SPY is below 455. That way we get to keep that $560 of credit. So hopefully you found this video helpful. If you did, show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.